The first thing is the people. Obviously, this business is about the connections you make and the people you trust. And the most important people that I trust in this industry are at this company.
The new beginning. Other companies are doing things the same way they've always done them. And so having a new opportunity to do things a different way is what really intrigued me.
I'd say from a sales perspective, what I love most is that we have really the best of both worlds. So we're a big multi-billion-dollar international company with great financials, but on the other side, we also feel very much like the small little family-run company.
I like the safety of First American, but they've got a human side to them, you know, a little softer, gentler approach, and I really appreciate that, and they've really given me a great opportunity to go out and try and build something for them.
In Colorado, guess what? We're all local. There's 4 local underwriters, and together the other day we have almost 125 years of local underwriting experience in Colorado. And I tell that to people all the time, and that's really the big difference. We can make local decisions quickly to get that deal to the closing table. That's the big difference.
We're a team, and we support each other and look out for each other, and it really promotes more business for us.
First American is all about a work-life balance, and the leadership is incredible because they truly care about the customers or the associates that work here.
This is our customer service department and the marketing support services that are just completely robust. Marketing is a challenge for a lot of real estate brokers. It's something they have to do, but it takes a lot of time. It can be expensive, and we have a fulfillment solution that is far and away better than anything else that our competitors have to offer.
The leadership is very down to earth, and they move very quickly. So anytime I've needed something or had to support a customer or had to make a decision that maybe cost the company money or whatever, they're very quick to make a decision on that stuff.
You're working with people who have been in this market, in the Colorado market, for 30 plus years. At one point, First American was underwriting almost 70% of all transactions in Colorado, and some of those very people were working on those files.
I really believe our people are passionate about our company and do it better.
The first thing is the people. Obviously, this business is about the connections you make and the people you trust. And the most important people that I trust in this industry are at this company.
The new beginning. Other companies are doing things the same way they've always done them. And so having a new opportunity to do things a different way is what really intrigued me.
I'd say from a sales perspective, what I love most is that we have really the best of both worlds. So we're a big multi-billion-dollar international company with great financials, but on the other side, we also feel very much like the small little family-run company.
I like the safety of First American, but they've got a human side to them, you know, a little softer, gentler approach. And I really appreciate that. And they've really given me a great opportunity to go out and try and build something for them.
In Colorado, guess what? We're all local. There's 4 local underwriters, and together the other day we have almost 125 years of local underwriting experience in Colorado. And I tell that to people all the time, and that's really the big difference. We can make local decisions quickly to get that deal to the closing table. That's the big difference.
We're a team, and we support each other and look out for each other, and it really promotes more business for us.
First American is all about a work-life balance, and the leadership is incredible because they truly care about the customers or the associates that work here.
This is our customer service department, and the marketing support services that are just completely robust. Marketing is a challenge for a lot of real estate brokers. It's something they have to do, but it takes a lot of time. It can be expensive, and we have a fulfillment solution that is far and away better than anything else that our competitors have to offer.
The leadership is very down to earth, and they move very quickly. So anytime I've needed something or had to support a customer or had to make a decision that maybe cost the company money or whatever, they're very quick to make a decision on that stuff.
You're working with people who have been in this market, in the Colorado market, for 30 plus years. At one point, First American was underwriting almost 70% of all transactions in Colorado, and some of those very people were working on those files.
I really believe our people are passionate about our company and do it better.
The first thing is the people. Obviously, this business is about the connections you make and the people you trust. And the most important people that I trust in this industry are at this company.
The new beginning. Other companies are doing things the same way they've always done them. And so having a new opportunity to do things a different way is what really intrigued me.
I'd say from a sales perspective, what I love most is that we have really the best of both worlds. So we're a big multi-billion-dollar international company with great financials. But on the other side, we also feel very much like a small little family-run company.
I like the safety of First American, but they've got a human side to them, you know, a little softer, gentler approach. And I really appreciate that. And they've really given me a great opportunity to go out and try and build something for them.
In Colorado, guess what? We're all local. There's 4 local underwriters, and together the other day we have almost 125 years of local underwriting experience in Colorado. And I tell that to people all the time, and that's really the big difference. We can make local decisions quickly to get that deal to the closing table. That's the big difference.
We're a team, and we support each other and look out for each other, and it really promotes more business for us.
First American is all about a work-life balance, and the leadership is incredible because they truly care about the customers or the associates that work here.
This is our customer service department and the marketing support services that are just completely robust. Marketing is a challenge for a lot of real estate brokers.
Good morning, and sorry we're just a few minutes late, but we're live and in charge now. My name is Wes Parham. I am the Business and Professional Development Director for the Colorado Association of Realtors, and I want to thank you for joining us today. As you know, credit can have a big impact on your client's buying potential, and we're lucky to have an expert with us this morning, Jim Kaiser, to walk us through some key items on helping us all get a better handle on what is otherwise a commonly misunderstood subject. And more specifically, he's going to show us how those items will improve your client's buying power. Jim will be available also to answer your questions, and I look forward to turning the program over to him in just a few moments. But first, I wanted to pass along a quick thank you to TransUnion SmartMove for sponsoring today's program. You may be aware that CAR recently partnered with TransUnion to provide a quick and reliable tenant screening solution that's tailored for real estate brokers. So whether you're helping your rental clients or managing your own investment properties, SmartMove is going to be a great resource for you, and you can learn more on that program by visiting coloradorealtors.com under the Business Services tab or by clicking on the URL underneath the screen that you're watching right now. I also wanted to pass along a special thank you to First American Title for their support in presenting our webcast program, which, as you know, is part of our professional development initiative here at the association. And Alyssa is here with us this morning from First American. I'd like to give her a few minutes to catch you up to speed on some of what they're working on. Alyssa?
Thanks, Wes. My name's Alyssa. I work with First American out in Westminster, Colorado, as a part of the sales team. And I'm here today just to give you a little bit more information about some of the resources that we have to help you in your business. The first of those is an application called Costs First. It is an application that gives you the ability to create net sheets on the fly, whether you're sitting in front of your clients or on your own at your home, mobile, or wherever you may be. It's available on Android, iPhone, and your desktop, and it gives you also the ability to create a HUD 1. And a good example of this happened to me just recently when I had a client come to me and ask me to order O&Es and net sheets for a friend of his who was selling multiple investment properties. He wanted to come to the table with some extra information and have a full layout and make it look professional. Well, I told him I would be more than happy to do either of those for him. I went ahead and ordered the O&Es, but I also told him that he could download this app and have all of these things ready, save print, or email to anyone involved in the transaction using just this application. So it's a pretty cool application. The other one that I will tell you about today is called My First Am. This is another very popular application that we use, and it's also available on any of your mobile devices as well as your desktop. And wherever you may be, it pulls up the information on the property that you're at, and it gives you transaction history, comps in the area, as well as, comps and a property profile. So it tells you, past price, who owns it, and how you can take it from there. So just a couple of the great apps that we offer.
Absolutely.
And if you have any questions, please feel free to give us a call. We'd love to be able to sit down with you, help you kind of move forward in your business, and just let us know how we can help.
Thanks for that, Alyssa. We'd encourage you to check those out. We appreciate you dropping by this morning, and of course, we appreciate the continued support from First American. Now, I have just a few more very brief housekeeping items for you. We've allocated an hour and a half for today's presentation with a 10-minute break scheduled at about 10 o'clock. If you have any questions along the way, please feel free to type those in according to the instructions there on your screen. What we do is we collect those, we'll review them during the break, and we'll have Jim address as many as he can after we return from that break. Finally, I did want to make a quick note that today's PowerPoint will not be available for download. However, we are recording the presentation, so you can go back and review anything that you may have missed at any time. There's also a summary brochure that you can download that will include much of the information that Jim will be covering this morning. So with that, our speaker, as I mentioned, is Jim Kaiser. Jim has over 32 years of experience in sales and marketing, including about 15 years in the banking and mortgage industry. He has been with Advantage Credit since 2005 and brings considerable experience in working directly with residential and commercial borrowers. Jim is an active member of the Mortgage Bankers Association as well as the Colorado Mortgage Lenders Association, and I think that you'll find him extremely knowledgeable on credit issues, and we're grateful that he's allowing us to borrow his time today. And with that, Jim, if you want to make your way on into the set here, I will let you have the remainder of the hour to discuss all things credit.
Thank you, Wes. So the name of the presentation is Increased Buying Power, Understand Credit Scores, and Wes mentioned that the presentation will not be available, but I want to share with you something I think will even be more valuable. And if you go to our website, which is at www.advcredit.com, and you'll actually find at the top of our page there's a section called Consumer Help. And if you go to that page, actually most of the information I'm going to be sharing with you today is actually listed on that site. It's no login or passwords required, a wealth of information, news articles, information you can cut and paste, share, put in your newsletters, link to it, and I hope you take advantage of that as well. And then last, at the very bottom of our page, you'll see an app that is available for iPhone, iPad, Android. I encourage you to download that app because we publish news articles once every 2 weeks related to the industry and changes in the industry, especially around credit. So feel free to download that free app, and you will be notified when we publish those articles on twice a month. So I'd like to take the time and just let you know what we will be talking about today. In detail, we're going to talk about what makes up scores, how they're impacted, how delinquencies, bad credit impact scores, including the new score model that's actually been out since FICO 08 or 2008. And then the Loan Quality Initiative. I do want to touch on just one item on that actually came out many years ago. And in addition, we're going to touch on 4 things that we are asked about often, and that is on credit disputes, how a bankruptcy affects my credit, as well as loan modifications and short sale versus foreclosure. In addition, we want to spend just a little bit of time on how to avoid identity theft. On average, 1 out of every 10 Americans are a victim of identity theft. And if you are working with a potential buyer and they are impacted by identity theft, that may put things on hold until they're able to get their credit back to normal. Security freeze is not to do with the cold weather, but actually something you may run into as well, and I'll address that. By then you'll all be experts. I'll just go over a few common credit questions we are asked. And then last but not least, a service that is becoming more and more important in the industry today is the ability to rapidly rescore or update and correct information at the credit level. And as Wes mentioned, we'll go over Q&A at the end as well. So what are credit scores? The first thing is, I guess, who knows what FICO stands for? And it stands for Fair Isaac Company. And FICO scores became available in the mid-90s, actually I believe 1995, in the mortgage industry. And it was originally used for doing assessments, risk assessments for the government industry, and then lucky us, we got this moved into the mortgage industry as well. And prior to that, most of the decision making on credit was based on doing an analysis of whether that person is willing or is there a high likelihood they will make their payments on time. And that's really the foundation of FICO. FICO scores, I know you'll see them, someone's going to be 580, someone will be 600, someone will be 700, 800, and you wonder, well, what determines all that? And really that is the main foundation of FICO, is when they look at all the different algorithms, at the end of the day, the primary thing they're looking for is there a likelihood or a willingness that they'll make their payments on time? Now, mortgage FICO scores range between 300 and 850. And just to give you an idea of what the market is today, the average or median FICO score for a mortgage FICO score is around 679. If you go online and pull up, if you Google the average FICO score online, you'll see they're going to state somewhere around 720, 729. And that's a different FICO score model. It's a personal FICO score, which I'll touch on in just a second. And then last but not least, on regards to credit scores, keep in mind that when a credit report is pulled, it's based on the information that at that very moment. So if maybe you made a payment the day before, it didn't show up on the report yet, it may show up 2 weeks later, 4 weeks later. So a credit report is just looking at that moment, have you paid your bills, have you not? It does not take in consideration if you've made payments earlier, but just whether you've made their payments on time. Now I mentioned there's different scoring models. There's actually over 27 scoring models out in the industry today. There's FICO scores for mortgage, FICO scores for credit or consumer loans, as well as different scoring algorithms for automobile. If you go to each of the bureaus, such as myfico.com or go to Experian, TransUnion, and Equifax, you'll find they each have their own scoring models. And on top of all of that, there's even a score model called Vantage Score. So it can get very confusing. However, to simplify this, in the mortgage industry, the real estate industry, the primary score, the only score that's used today by Fannie and Freddie, is a FICO score, which is the mortgage permissible purpose. So what makes up a credit score? And this is the part I think can be a little misleading. Most feel that if I just make my payments on time, I should have great credit. But in reality, almost 50% of your FICO score is based on payment history and the length of that payment history. So occasionally we'll see someone that'll say, hey, I got good news, I just paid my car off, that should raise my FICO score. Well, the minute you close an account, pay off an installment loan, that payment history is no longer applied to your FICO score algorithm. Therefore, by paying off an account and closing it, that's the key, closing it, you could actually lower your FICO score. Another piece to a big impact on FICO scores is balances. And that's balances on credit cards and home lines of credit. And that 30% actually means something else. If you're working with a potential buyer and they have multiple credit cards and they may ask you, I have high balances on all of these, should I pay them off? What should I pay them down to? The recommended percentage is 30% of the high credit limit. So for example, if you have a credit card with a $1,000 credit limit, the goal should be is to at least get that balance down to $300. And that will provide the biggest impact or possible gain on your FICO score. Obviously, paying the cards off can help as well, but the goal is at least get them down to 30% of the high credit. This is unique to the mortgage industry, and we get asked this often is, well, what should I have? How many cards, how many loans? What should my credit portfolio look like? And by the way, if any of you have this exact healthy mix of credits, chances are your FICO scores are probably in the 800s. So in a perfect scenario, we're looking for at least 2 installment loans with balances. So a mortgage, a car loan, student loan, something with a fixed term, fixed payment. In addition, 3 revolving accounts, credit cards, lines of credit with balances less than 30%. Of course, the no-brainer, no derogatory items, no collections, late payments, etc. And then last but not least, on top of those 2 installment loans and the 3 revolving accounts, it's okay to have additional credit cards that you've had for a long time with long payment history that maybe you use once in a while, but you basically pay them off every month. So if you have this mix of credit, chances are you're somewhere in the high 700s, probably even in the 800s. I'm going to list all of these on one slide here, and these are the delinquency, the bad credit information, and how do these affect your score. And as you can see, if any of these show up on your credit report, chances are they're going to be on your report for at least 7 years. Now the real question is, how do they impact your score? If your FICO score is 800 and 1 late payment shows up on a department store credit card, how much could your score drop by? Now, I hear people say, oh, probably 40 points, 50 points, 60. No, in reality, it's probably going to be at least 100 points. So if any of these show up on your credit report, expect at least a 100-point drop in your FICO score. Now, the good news is if you have a late payment that's been on your credit report for over 2 years, after 2 years, they're really not affecting your score as much as it did when it initially showed up on your credit report. So that rule of thumb is if you're at month 25 on a collection that's not been reported since then, a late payment, etc., don't worry about those. Chances are they're not affecting your score, even though they're showing up on your credit report. Now, Fair Isaac was willing to share some information, some of their secrets about this in regards to how it affects your credit. And as you can see, by increasing or maxing out your credit card could potentially lower your score, but notice that 30-day late payment. If you're at a 780 FICO score and you have that one 30-day late payment, your score could drop 90 to 110 points. And we consistently see that when a collection or a late payment shows up. Bankruptcy could be substantial, especially if you have a high FICO score at the start. If you're at 780 and you file bankruptcy, your score could potentially drop over 200 points. I want to touch on some good news items, some recent changes. And one is an item that's actually been introduced to the House. A bill was introduced in 2011, then 2012, 2013. I believe the CFPB is trying to take hold of this and launch this. And bottom line is we find that many credit reports that are pulled and people have some type of a collection on them, it's usually because they have a medical collection that they didn't even know about. A $150 x-ray bill that somehow the bill didn't get to them, they didn't know about it, they thought the insurance paid for all of it, and now when your credit's pulled, you're ready to pay this off. Well, the problem with paying off a collection is when you pay off a collection, it doesn't come off your credit report. It updates the collection information and brings the date forward. And by bringing the date forward, it makes it look as if it's a new credit, or a new collection. The good news is on medical debt, there are plans, it's not in place today, that in the future when you pay off a medical collection, and I believe there's a dollar amount which is somewhere around $3,500, that it will automatically remove off the credit report within 45 days. Now, since this is not in place today, what you can do is if a customer has a medical collection, I encourage them to call the collection agency first and ask if they pay off that collection, would they be willing to remove it from the credit report immediately? In most cases, we find medical collection companies are willing to do this. The most important part is make sure you get it in writing first before you pay that collection. This is great news, and actually a slide back, you may have noticed that on federal tax liens, once you pay that tax lien, That's when day one starts, and then it still remains on your report for over 10 years. Well, back in 2011, the IRS announced that once you pay off a federal tax lien, you can go to their site, pull up some documentation, and send that information in to the IRS. And they will remove that tax lien, usually within 4 to 6 weeks. So this is great news. Once you've paid it, it's not going to stay on your report for 10 years. And then last but not least, Experian is starting to report rental history, because we do know that a large portion of people today that are buying homes are first-time home buyers. Many of these people have been renting in large property management apartment complexes, etc. Wouldn't it be nice if that information showed up on their credit report as well? So Experian actually works with Rent Bureau, and they will report positive rental history on the credit report. Now, it does not affect FICO scores at this time, but we do see this down the road possibly being implemented. So not only does that rental history have a positive impact as showing a trade line, showing proof of making payments, but also seeing the FICO score as well. Now, I mentioned FICO 08 at the beginning. You're probably wondering, why is Jim showing me FICO 08? We're in now 2014. Well, the most recent scoring model that FICO introduced is currently called 08, which actually was introduced in 2007. It was introduced and it's available to all the credit reporting agencies back in 2009. And actually today, over 400 lenders, or the majority of the top largest U.S. banks, nationally and credit card issuers, actually use FICO 08 to determine credit worthiness. However, Fannie Mae and Freddie Mac have not approved this yet. My belief is that when FICO comes out with a new scoring model, they'll probably implement these changes into this new score model as well. So I want you to just be aware of what's coming, and this is really actually good news. One is, there was thought that authorized accounts would no longer be factored into FICO scores, but they will continue to recognize legitimate authorized users, meaning immediate family members that you can add onto an account to give them some credit so they can help build credit on their own. They're also looking to extend the number of segments, problem segments, from 2 to 4. Now, why is that important? I think we would all agree that if you have perfect credit and you have one late payment show up, I think we'd all agree that it's not really fair for your credit score to drop by 100 points. So by extending this out to 4 segments, they'll have additional segments that you could be categorized in. So if you have just one little hiccup on your credit report, instead of your score dropping 100 points, hopefully it will only drop maybe 40 or 50 points instead. On top of that, they're going to ignore small collections for under $100. Now, they'll still be on your credit report, but they're not going to factor those in as well. Continued emphasis of being careful about don't closing accounts, because if you close an account, that payment history goes away, which could lower your score. Now, again, if you have 8 credit cards and you'd like to get that down to 3 or 4, kind of that perfect credit mix, then what you can do is you can close the ones that you've had the least amount of time with. Keep the ones you've had open the longest, keep those open, because there's more payment history that can apply to your FICO score. And then last but not least, I mentioned to you earlier that 30% is that perfect balance to get to have the biggest impact on improving your FICO score by paying down credit cards. They're now saying that if you get it down to 10%, that will even have an additional positive impact on your scores as well. We probably have all heard of Fannie Mae or risk-based pricing, and actually back in, I want to say about 4 or 5 years ago, if you brought a customer to a lender and you said their FICO score was 680, that was the best score that you needed. You could get the best rate on any conventional or FHA loan. Now, there are many properties today that are not FHA approved, and you have to go conventional financing. So I wanted to give you kind of a worst case scenario here of how risk-based pricing impacts a person's buying power. So today, if a borrower wants the best interest rate and they must go conventional, today you must be at least at a 740 FICO score. Amazing. I never thought I'd see the day that you have to be above 740 to get the best rate. And as an example, if you have a customer, let's say their scores are in the mid to 670, for example, 670 FICO score, and they want the best interest rate on a $250,000 home loan, they may have to pay up to $7,500 upfront in points to get the best interest rate. Or if they choose to accept the rate they deserve based on their low FICO score, they will end up paying over $9,000 in additional interest just in the first 3 years. So obviously FICO scores have a huge impact on the ability to pay and also the cost that you'll incur up front. Now this is just an example of one of many Fannie Mae risk-based pricing tables, and I never thought I'd see the day where if your FICO score is 720 to 739, that you would or could potentially have to pay some points in order to get the best rate. Let me take this a little further. Now I know all of you today work with the lender up front before you go out and show property. That's the smart thing to do. You want to make sure they've been pre-approved, what their scores are, what they qualify for before you go out and show property. So let's just give you an example of how those FICO scores can affect a person's buying power. Let's say you're looking for a home in the 350 range, and they're going to put 10% down, and their loan amount's going to be $315. If their FICO score is 719, and by the way, don't hold me to this payment, it's just an example. I'm not sure what rate I was using back then, but if at 719 your PI payment's going to be around $1978. If your FICO score is just 40 points lower, you're going to pay $60 more per month for that same loan. And if your FICO score is 649, you're going to pay $230 a month more for that same loan. Now something else lenders look at is a front-end back-end ratio. So on the front-end ratio, they take the principal, interest, taxes, insurance, HOA fees, etc. to qualify that person. So let's say that $1978 payment is what the customer must qualify for to get this loan. Well, if you're at FICO score of 719, you're in the door, you've got your home, you're going to be able to qualify for a home in the 350 range. But if your FICO score is just 40 points lower, you'll have to go back and renegotiate a new price because now they can only afford 340. And hopefully they're not at this, but at 649, now you're looking at houses in the 315 range. This is why it's so critical to make sure you bring your customers and work with the lender up front to make sure you identify their scores, their potential buying power. Now here's the good news. The good news is most lenders provide a consultation report that can advise your customer on how to improve their score naturally during the buying process. So if they're selling a current home, they're out looking for a new home with you, that might take 2, 3, 4 months. So what would be helpful is to give information to your customer that says, okay, I know you're at 649, but if you do these things, you'll be able to raise your score up to 719 as an example. So I encourage you to ask your lenders that you work with that they provide you this report. By the way, it's called Credit Analyzer, the actual name. And every lender out there has access to this report. And they should be providing this report to your customer at the beginning during that pre-approval process. What's great about this is it tells the customer what they need to do naturally to improve their score. So now they have a game plan while they're out looking for homes. It'll tell them what they need to do. Valuable information for you to be sharing with potential new customers to say, not only am I going to get you in the house you want, I'm also going to work with this wonderful lender here that can provide you this report as well. Loan Quality Initiative, which came out many years ago, back in 2010 to be exact. I wanted to touch on just one item here because all of these things have been in place for a while now. We need to verify the borrower's identity, validate social security numbers, the red flags, et cetera, et cetera. But this is the one I wanted to touch on for you, and that is to verify undisclosed liabilities. This is now a requirement by Fannie Mae that for every lender that does a loan, prior to closing, we must verify all the liabilities are still the same as they were when they first applied for the loan. So possibly remember the days when maybe you put a contract on the home and your house and then your mortgage would be approved and then maybe you didn't close for another week and there was that perfect time to go out and buy new furniture and a washer and dryer, refrigerator for your house. That is no longer an acceptable practice because the lender is going to verify, did you go out and borrow money? Did you borrow money? What was this inquiry for, etc. So I encourage you to emphasize to your customers, even more so now because it is being tracked right before closing, that they should not use their credit cards, go out and buy a new car or anything until after they've closed on that house. And then that bullet point I was just touching on, that's really the primary thing I wanted to touch on. So here are the next 4 items are questions we get asked often. This one has come up often, and this is credit disputes. And by the way, if any of you work with a credit repair company, I would be extremely careful about, one, recommending one to your customer, and if your customer is considering one, I would make sure that you find out exactly what they're going to offer. In the past, most credit repair companies, what they would do is they would recommend you dispute all of your derogatory information, whether it's true or not. And once you dispute it, it no longer affects your FICO score, and now go get a mortgage. Well, guess what? Today, if you dispute a derogatory account, it is, in most cases, still factored into the credit score. And interesting enough more is when you dispute a good standing account, it will not be factored into your FICO score. So it's kind of a loss-loss. So be very careful about customers coming to you saying, I was told to dispute my bankruptcy, dispute this. Ask, is it real? Is it correct? Is that yours? Yes, it is. Then don't dispute it. And the reason why is because this is an underwriting problem. When submitting this through for underwriting purposes, the lender will not be able to submit a file through Fannie or Freddie through an automated system if any disputes are on that credit report. So that's a question you might ask a customer up front if they've disputed anything, or let's make sure those are all cleaned off because it could delay your loan closing. Many people are coming out of bankruptcy right now. They're ready to buy a home. And what we find right now is often, I'm just going to put these all up here because it really comes down to one thing. We're finding often that when the credit report is pulled and we compare it to their original bankruptcy schedule, sometimes they'll find that not all the accounts on the schedule are showing up on the credit report as part of the bankruptcy. So the obvious would be is, well, we need to update the credit report and make sure all those are listed as part of the bankruptcy. Makes sense? Seems reasonable? But what happens is when we add those other accounts as part of the bankruptcy, guess what? It brings the bankruptcy date forward to today. And it makes it look like it's a very recent bankruptcy. And what it will do is lower your FICO score. So my recommendation is if there's a discrepancy between what's on your bankruptcy schedule and the credit report, my recommendation is just leave it alone. It's not affecting your score worse, and just wait maybe until after you've closed, and then you can work on cleaning up the credit report. When loan modifications came out many years ago, there was one thing that did not happen. And Fannie Mae did not go walk down the hall to FICO, not that they're in the same building, and say, hey, by the way, when we do a loan modification, don't penalize my customer. Because when they first introduced loan modifications, they did report it as a repayment plan, basically similar to a bankruptcy. And the statement would be stated, or on the credit report, it would say partial payment plan, and has a negative effect. Here's the good news. Most lenders now that do provide a loan modification for a consumer normally will report that as paid as agreed. So they've gone away from that. But if you by chance are being asked by a client or customer you're working with, maybe they've done a loan mod, they're in the process of doing one prior to maybe buying a new home, make sure they contact their lender and make sure they get in writing that if we do this loan modification, that you're going to say paid as agreed on my account. Now this goes hand in hand with short sale versus foreclosure. I'm sure many of you, when you took that first class on short sale versus foreclosure, that they said short sales are much better for your FICO score than a foreclosure. And that's true, because a foreclosure may affect your score 110 points and a short sale would be 105. So not really a big difference. And the reason why is because neither are good for your score. And matter of fact, they're both of them are reported as settled for less than full balance. So there really wasn't a big difference between a short sale versus foreclosure. Here's the key. Again, similar to loan modification, it's how it's reported on the credit report. And talking with many title companies and people that specialize in short sales, I'm seeing a continued trend that if you, the current seller of the home, work with the lender and say, I know when I sell my house for $200,000 and my loan balance is $250,000, would you be willing to forgive that $50,000 in its entirety and say paid as agreed on my credit report? Sometimes they'll come back and say, no, we won't forgive the full amount, but we'll forgive a portion of it if you would be willing to do an unsecured note for the difference, and then we will say paid as agreed on your account. So again, I encourage anyone you're working with on a short sale where the seller is going to do a short sale, make sure they're working with the lender and get something in writing that says paid as agreed. And we're seeing more and more of this happen, and you can walk away from a short sale with perfect credit. I didn't note this on the presentation, but I was excited to find that Fannie Mae back in, I think it was November 16th, actually announced an upgraded version of the direct underwriting software and the guidelines, and it now can distinguish the difference between a short sale and a foreclosure. That was an issue for some time, but that now has been fixed, so good news there. So these are some things you can be doing to either improve your score or things you shouldn't be doing to keep your scores up. One thing I recommend up front is be very careful about co-signing loans. Most people don't realize when you co-sign a loan, their loan is now your loan. And if they're late, guess what? You're late. I always tell people if you're going to co-sign a loan, you just as well take ownership of the payments and have them pay you instead to make sure it doesn't affect your credit. We already talked about be careful closing accounts, because if you close too many of them, that payment history goes away, could lower your FICO score. And be very careful about opening up new accounts for that, that initial quick savings. Perfect example during the holidays. You go to a store, you have all these gifts, you sit down in front of the counter, and what do they ask you? Would you like to save 15%? Open up this credit card. When you open up that credit card, first of all, that inquiry is going to lower your score. Could be 10, 20, maybe even 30 points. And then that credit card usually has a very low credit limit. So you're probably going to max out that credit card, which also will lower your score. And on top of that, when you get your bill in January, what do you do with that account? You pay it off and close it. So here you've opened up an account for a short-term gain to save money, but in the long term, it lowered your score 30, 40, 50 points. So just be careful doing that, especially if you already have that perfect mix of credit. A great way to build credit, if you have bad credit today, maybe you're starting over, maybe you filed a bankruptcy a while ago, or you're coming out of school and you're looking to build your credit, and it's hard to get an unsecured credit card. Most banks and credit unions offer secured cards or secured lines of credit. So what you do is you go to the bank where you bank at or credit union, you give them a certain amount of money, they use that as collateral, let's say $200, and they actually establish a credit card with a credit limit of $200, and they would report to all three bureaus. It shows up on the credit report just like a normal credit card, and it's a great way to build credit. I get asked often is, be careful, don't pull my credit, it's going to hurt my score. Well, actually, credit inquiries, when you're doing a mortgage inquiry, you have up to 45-day window to have as many mortgage inquiries, and it only affects your score as if it was one inquiry. So you have an opportunity to do some shopping. Same thing with car loans. If you have shopping for a car and you're going to different dealers and they're pulling your credit each time, as long as it's within that 45-day window, don't worry about it. It does not affect your score. Now, when you get outside of that 45-day window, it could start to have a negative effect on your score. But where I see people usually affected by this is when they're shopping consistently. 3 inquiries in January, 2 in February, 4 in March, and so on. Now, when you pull credit on yourself, that is considered a soft hit. And I'm going to show you a URL soon here where you can pull your credit for free. And that is a soft hit, so it does not affect your score. And by the way, those you do business with, those who, credit card companies, etc., that do business with you, they have a right to be able to go in and pull credit on you and look at your credit status. And those are also soft hits, so they do not affect your credit. This question was really about what defines a 30-day late. And a 30-day late is exactly what it says. And that is if a mortgage is due on the 1st, you don't make the payment until the 15th or the 16th. Yes, you may incur some additional charges, but you're not officially 30 days late until the 1st of the next month. So you could be making mortgage payments, not that I would encourage this, but you could be making mortgage payments on the 28th every month, that late, but it would not show up as a 30-day late on your credit report. I mentioned identity theft and how much that can impact a customer's buying power, because it can take hundreds, if not thousands of dollars to get your credit back to normal. And it can take months, if not years, to get your credit back to normal. So these are just some things you might want to recommend to your customer to help avoid identity theft. One is, by the way, if you are a victim of identity theft, just contact one of the bureaus, Experian, Equifax, TransUnion. They'll contact the other two, and all three of them will put a 90-day fraud alert on your credit report. They'll also offer monitoring services, which I would encourage you taking advantage of at least for 12 months, and additional services as well to protect you. But definitely the first thing you should do is contact one of the bureaus. Now, one of the things you could do to avoid identity theft, really the end to your credit information, is your Social Security number. So be careful about just openly sharing that Social Security number with you or with other people. It used to be a very common practice when you were applying or when you were joining an association or going to the doctor's office or the dentist, that somewhere on that application you'll see Social Security number. Just leave it blank. See if they really need it. It used to just be something they collected, but they never did anything with it. And if they do ask for it and they want it, ask what they're going to do with it. Are they going to pull credit on you? If not, could they just accept the last 4 digits of your Social Security number? So be very picky about who you give that information out to. When you get those, you've been pre-approved for a 0% credit card in the mail. I've heard many people say we just take those and rip them in half and throw them in the trash can. Well, dumpster diving is huge today. People will go into your trash cans, they'll find statements, and they'll tape them back up. They'll send them in and say, guess what, I did want that credit card. I apologize for ripping that up. And please send it to me somewhere else, not here. So be very careful about all statements, solicitations you receive. Please, if you do not have one, go get a shredder and shred every statement, solicitation you receive, and make sure it's not accessible in the trash can. And never mail payments from home. If you have that mailbox with the red flag, guess what? That's what the red flag's for. To tell everybody to come by and get your personal information, to get your check, etc. So always take your mail to the post office, or at least one of those mailboxes in front of the post office. Now, I would encourage you not to go to a mailbox somewhere off far away on a street corner, because what people will do is they'll take a tennis ball and they'll wrap it with duct tape backwards with a string on it, and in the middle of the night they'll go out to that mailbox and drop it in and try to take mail out of the mailbox. So that's why we encourage people, make your payments at the post office, or at least those mailboxes in front of the post office for security purposes. Electronic signatures. When you swap your card and you sign in that little box at a store, you're purchasing something, always leave room to put the date of that transaction. And actually 80% of identity theft occurs across the counter. So what happens is, if you've ever noticed when you sign your name on that little box, you look and see on the computer screen that signature is now embedded into their system. And what will happen is someone maybe 2-3 days later may come back within that company and may decide to use your account to go buy something for themselves. They won't use your account and your signature because you dated it. They'll use someone else's. Also, when you're at a restaurant and you have that paper come to you to sign your name, at the end of your signature, make sure you also date your signature, just so it's not used elsewhere. Okay. And if you still have your statements being delivered to you, make sure you know when they're delivered, because guess what? If you're not mailing from home, you're probably still getting some things delivered to your home. You don't want that credit card statement sitting in your mailbox all day long. I encourage you actually to move to having all of your statements moved to an electronic version. And by moving to an electronic version, that way you can get the information and nothing's showing up in your mailbox. Now you may say, Jim, that's not very secure, the internet. And actually, what defines a secured website, it used to be the lock on the bottom right corner of the computer screen. And then people started putting fake locks up there. So what really defines a secured site is when it says HTTPS, the S for security. That is an encrypted website. So anytime you're buying something online, you'll probably notice when you get to the section that asks for your credit card information, make sure you look at the top and where it says HTTPS. If it doesn't, then definitely do not put your credit card information in. Now this is a great place to go to monitor your credit on an annual basis. And by the way, you get a free credit report from each bureau once every 12 months. So my recommendation would be is pull credit from, let's say, TransUnion, wait 4 months, pull one from Equifax, wait 4 months, pull one from Experian, and allow these free credit reports to allow you to monitor your credit throughout the year. And especially if you're thinking about making that major purchase down the road, you might want to send out a newsletter to all of your customers and letting them know before you come in to start thinking about buying a new home, let's go and check your credit months in advance to make sure everything is nice and clean. Last thing I want to touch on here before I think we get into just a little bit of Q&A I'll go over, and that is the bureaus are selling information. So when a lender pulls a credit report, you probably have come across this where your customer will say, well, the very next day I got phone calls from 2 other lenders saying they understand I'm looking for a mortgage and they can do a better job, or whatever their sales pitch is. Well, what's happening is the bureaus are actually selling your information when your credit is pulled. Not the lender, but the bureaus. But there is a solution, and the solution is to opt out from your information being sold. And how you can do that is by going to optoutprescreen.com, or you can call this number at 888-567-8688. It usually takes about 5 to 7 days to go into effect. But once you've done this, when your credit's pulled, it will not be sold to other companies going forward. The great thing too is when you do this, it actually minimizes your junk mail, because all those solicitation emails or mails tend to go away. Security freeze, and I bring this up because more and more people are trying to protect their credit, and so what they do is they do a security freeze which blocks their credit file from being accessed. And it is available in all 50 states, and it actually is a free service if you've been a victim of identity theft. If you wanted to just do a security freeze to protect yourself, it's usually $10 to $15 per bureau, so not too expensive, and you can do this online or still through by mail. This is a question you would want to ask a customer when you first start working with them is, do you know if you have done a security freeze on your credit? Because guess what, if they have, if you bring them into the lender will not be able to pull their credit. And it can take sometimes days, if not weeks, for your customer to find their PIN numbers and get that security freeze lifted. So make sure you get that identified up front, way prior to the contract on the home, so it doesn't delay the loan closing. Okay, just some common credit questions that we come across. Will paying off a collection remove it from a report? No. The collection must stay on the report for 7 years. A question I get asked often, though, is what at the end of 7 years, if there's still a balance on that collection, does it come off? And the answer is yes. So at the end of the 7 years, whether there's a balance or not, it comes off your report. And if you did want to pay the collection agency or the original creditor, who should you pay? You definitely want to go to the collection agency. They're the ones that they've already purchased it from the creditor. They're the ones that are actually hurting you on your credit file, so you always would want to pay the credit agency. And can paying off a collection hurt your score? We talked about that a little bit earlier. Most definitely, in most cases, yes. And that's because by paying off a collection, it's going to bring the date forward to today and make it look like a new collection again. Now, if you can get the collection company to remove the collection, then it's actually going to help your score. And does a $500 collection impact your score any differently than a $50,000 collection? The answer is no. Collection is a collection. It doesn't matter the balance. It's just whether it is a collection. We often get asked whether divorce decrees are accepted by the bureaus. Let me just simply say they do not. So if the divorce decree says this person is going to get this credit and this one and this account and this account, bottom line is it's up to them to refinance and get those accounts moved over appropriately. The bureaus don't care about a divorce decree. And if you do have an inquiry that you think that's affected your score, that you do need to remove, how you do that is go to that annualcreditreport.com site, contact the bureaus, and then you would be disputing that inquiry, but hopefully you could get that removed within 30 days. Now, why do we have different FICO scores? When your FICO scores are pulled for a mortgage, usually all three are pulled. You might see a 680, 670, and then a 520. And the reason why is because not all companies report to all three bureaus, especially collection companies. Collection companies might often report to just one bureau. Now, if all three had the exact same information reported to them, the scores would be within 1 point of each other. They're all using the same scoring models. And the last thing I wanted to mention was on rescoring. So what is this? It's a service that the lenders can work with your customers on to correct information at the bureau level. Is it permanent? Yes, in most cases it is. And mostly what we're doing is paying down balances on credit cards, removing late payments, or removing collections. So if you have a customer that says, working with the lender, that these balances are actually too high, I just paid these off, we can actually take an updated online statement, submit it to the bureaus, and it actually could be removed within 3 business days. So make sure your lenders that you're working with today have contact that they can do these rescoring services as well. Last page, and then we'll get to the very last section, and that is what are the best ways to remove a late payment, because I just mentioned that's something we do. So here's a chance for you to be a hero. If you have a customer that says, well, I have great credit, but you know what, we made a mistake last month and we were late on our mortgage, and now we've got this late payment that lowered our score 100 plus points. Have your customer call that company. And when's the best time to call? On Friday. Never on Monday. People are not in a good mood. Friday's the best time to call a company, and what you'll do is you're going to ask for a courtesy removal. Sometimes they'll call it re-aging. But basically you're saying, would you just this one time, since I've had perfect credit with you, would you just this one time remove this late payment? 85–90% of the time companies are saying yes. We will not rescore or update derogatory items. Again, those only hurt your score. And then we're unable to remove inquiries, and we're unable to add anything at the bureau level until it's actually reported. So after all of this, it comes down to 4 simple things. And if you follow these, you'll have great credit. One is, don't open up new accounts unless you don't have that perfect credit. Don't close the ones you have, especially the older accounts. Keep that payment history intact. Make sure you keep your revolving debt to a minimum, which is around 30% or less, and then pay your bills on time. It's that simple. Thank you for your time. Wes, back to you.
Thanks, Jim. We really appreciate that. Excellent information. Thank you again for your time.
Thank you.
And you got through an impressive amount of information there in about 15 minutes. So we appreciate that. With that, we're going to take just a quick 10-minute break. The purpose of this break is to allow you to submit any questions that you may have pending on your mind. Now would be the time to ask those. This will be your last chance. We'll come back from the break and we'll have a little discussion with Jim, and he'll answer as many as he can. We'll see you in just a few.
The first thing is the people. Obviously, this business is about the connections you make and the people you trust. And the most important people that I trust in this industry are at this company.
The new beginning. Other companies are doing things the same way they've always done them. And so having a new opportunity to do things a different way is what really intrigued me.
I'd say from a sales perspective, what I love most is that we have really the best of both worlds. So we're a big multi-billion-dollar international company with great financials, but on the other side, we also feel very much like the small little family-run company.
I like the safety of First American, but they've got a human side to them, you know, a little softer, gentler approach, and I really appreciate that, and they've really given me a great opportunity to go out and try and build something for them.
In Colorado, guess what? We're all local. There's 4 local underwriters, and together the other day we have almost 125 years of local underwriting experience in Colorado. And I tell that to people all the time, and that's really the big difference. We can make local decisions quickly to get that deal to the closing table. That's the big difference.
We're a team, and we support each other and look out for each other, and it really promotes more business for us.
First American is all about a work-life balance, and the leadership is incredible because they truly care about the customers or the associates that work here.
This is our customer service department, and the marketing support services that are just completely robust. Marketing is a challenge for a lot of real estate brokers. It's something they have to do, but it takes a lot of time. It can be expensive. And we have a fulfillment solution that is far and away better than anything else that our competitors have to offer.
The leadership is very down to earth, and they move very quickly. So anytime I've needed something or had to support a customer or had to make a decision that maybe cost the company money or whatever, they're very quick to make a decision on that stuff.
You're working with people who have been in this market, in the Colorado market, for 30 plus years. At one point, First American was underwriting almost 70% of all transactions in Colorado, and some of those very people were working on those files.
I really believe our people are passionate about our company and do it better.
The first thing is the people. Obviously, this business is about the connections you make and the people you trust. And the most important people that I trust in this industry are at this company.
The new beginning. Other companies are doing things the same way they've always done them. And so having a new opportunity to do things a different way is what really intrigued me.
I'd say from a sales perspective, what I love most is that we have really the best of both worlds. So we're a big multi-billion-dollar international company with great financials. But on the other side, we also feel very much like a small little family-run company.
I like the safety of First American, but they've got a human side to them, you know, a little softer, gentler approach. And I really appreciate that. And they've really given me a great opportunity to go out and try and build something for them.
In Colorado, guess what? We're all local. There's 4 local underwriters, and together the other day we have almost 125 years of local underwriting experience in Colorado. And I tell that to people all the time, and that's really the big difference. We can make local decisions quickly to get that deal to the closing table. That's the big difference.
We're a team, and we support each other and look out for each other, and it really promotes more business for us.
First American is all about a work-life balance, and the leadership is incredible because they truly care about the customers or the associates that work here.
This is our customer service department, and the marketing support services that are just completely robust. Marketing is a challenge for a lot of real estate brokers. It's something they have to do, but it takes a lot of time. It can be expensive, and we have a fulfillment solution that is far and away better than anything else that our competitors have to offer.
The leadership is very down to earth, and they move very quickly. So anytime I've needed something or had to support a customer or had to make a decision that maybe cost the company money or whatever, they're very quick to make a decision on that stuff.
You're working with people who have been in this market, in the Colorado market, for 30 plus years. At one point, First American was underwriting almost 70% of all transactions in Colorado, and some of those very people were working on those files.
I really believe our people are passionate about our company and do it better.
Okay, thank you for all your questions and welcome back. We had quite a few of them, so we're just going to jump right in, Jim.
Okay.
First question, can I access my FICO score online, and separately, is that the same score that's used for the purchase of a home?
Great question. The FICO score online that you can purchase, whether it be through myfico.com, through annualcreditreport.com, they are personal FICO scores or a unique score from the bureaus, but it is not a mortgage FICO score. The only way you can get a mortgage FICO score is to apply for a mortgage. That is the only way you can get a mortgage FICO score.
To apply for a mortgage?
Yes.
Okay. Sticking with FICO scores then, what can I do, or what types of credit, and I believe that you covered some of this material, but if you wouldn't mind reviewing, what types of credit should you have to make up that good FICO score, specifically for the purchase of a home?
Yeah, that perfect mix of credit. So having 2 installment loans, whether it be a mortgage, car loan, student loan, any type of fixed term payment, and then having at least 3 credit cards, 3 lines of credit or credit card combinations with balances at 30% or less than the high credit. And it's okay to, again, to have additional credit cards that you've had for a long time. So it's okay to have 7 or 8 credit cards you've had for long, you got a long payment history.
Right.
But the goal was only have 3 of them with balances.
Got it.
Yeah.
3 cards.
Right.
Magic. 3 cards.
Magic 3 cards.
Got it. So a lot of our members might find themselves in dealing with clients in this situation. Either they're a first-time home buyer, they're young, they don't really have much of a credit history yet, and that does happen occasionally. Or probably more commonly, they're dealing with a client that may have had foreclosure several years ago, or have had other instances where it's kind of wiped out their credit. They've had to hit the reset button. What are some good ways to help rebuild that, both over time and maybe some some best practices of getting some bumps in a little bit more quickly?
You know, it's a great question. I'll give you an example of when people file bankruptcy. You'll see two types of scenarios where one will file bankruptcy, and you know the last thing you want to do is go out and borrow money again. So you start paying cash for everything. And then you have the other person that files bankruptcy, and then they try to reestablish credit. And what you'll find is, you know, three years later, the one that didn't borrow any credit and didn't reestablish anything, they still have terrible credit, still
Right.
real low FICO scores. And so what we encourage people to do, even if you filed bankruptcy or you have bad credit or you have, you know, you're trying to start out new, is to go get a secured credit card or a secured line of credit. And usually banks and credit unions offer these. So you'll provide them a certain amount of money as collateral, $200, $500, whatever, and then they will actually hold that and then set up a credit card or a line of credit for you that you can use just like a normal unsecured line of credit card.
And the key is to ask the bank and make sure that it's a secured line.
Well, even more important, ask if they will report to all three bureaus.
Got
That's
it.
even more important.
Got it.
Yeah.
So ask for a line of credit,
Right.
secured, and ask them to report that to
All
the
three.
bureaus. Got it.
Yep.
All three. We were also we were talking about some quick ways of helping to bump the credit during the break, and you
Right.
gave me an example about that Kohl's card. Do you mind kind of going into that a little
Yes, we didn't touch on this. Occasionally we'll find a customer that has, say, 3 credit cards, and they have one that they use often, and the other 2 they have not used, and I'll use the example of a Kohl's card. So if you have a Kohl's card you've had for, let's say, 10 years, but the last time you used it was 5 years ago, we often will encourage customers to go out and charge. The key is a small amount on that credit card. And actually what it does is it brings the date of activity forward to today. So overnight you go from 5 years to 10 years of payment history. So in those scenarios, in most cases, by charging a small amount on a card you haven't used in a while, it usually will increase your FICO score, again, because you've now extended the payment history on that account.
Thanks for that. So let's talk about credit cards. First of all, is it good that I pay off my credit card in full every month?
It does not hurt to pay off your credit card every month. Doesn't hurt at all. You can pay it off. We have found some instances where if you pay off a credit card to $10 versus paying it down to 0, sometimes paying it down to 10 actually gives you a little better improvement. Not much, maybe a couple points.
Right.
But overall, it doesn't hurt to pay off your credit cards every month.
So should I carry a small balance on those?
It doesn't. Probably what's more important is to use your credit cards at least once every 3 months. That's probably the most important part, because if you pay it off and then all of a sudden you don't use it for 6-7 months, you're not building that payment history. So you want to use your card at least once every 3 months.
Got it.
And it's okay to keep a small balance on it, most definitely.
Got it.
But you can pay it off too. I think the real more important part is if you're getting ready to apply for a loan and you have the ability to pay off that card, and let's say the card has a very high balance on it, make sure you pay that card off first.
Right.
Give it 30 days to report before you go in and apply for a loan.
Oh, that's good advice.
Yeah.
So let's talk about closing credit cards.
Okay.
Maybe there's a scenario where someone might find themselves in where they say yes to all of those vendor credit cards at 10% off, you get to 15% off today, and you end up with 15 or 20 credit cards literally.
Right.
What's the best way, once you make that conscious decision of weaning yourself off of those without really damaging your credit in a short amount of time, to start closing those out?
I would recommend, if you have, let's say, 8 credit cards and you want to get it down to 3 cards, then what you would do is just look at when do those accounts open up. Look at the open dates and keep at least 3 cards with the longest payment history, the ones that you've had the longest. Close the ones you've had the shorter period of time.
So you used an example of 8, not 20. You don't believe that people have 20?
I'm sure that people have 20.
We'll talk afterwards then. So then can paying off, let's kind of shift away from that for a second. Can paying off a significant size loan like a student or a car loan or even a mortgage help improve my score?
Paying off installment loans or paying them down, balances on installment loans do not affect your credit. The payment history on an installment loan can affect your credit because once you pay off an installment loan, in most cases it's going to close. And by closing that account, all that payment history goes away. So in some cases, paying off a mortgage, paying off a student loan, a car loan, sometimes your score could drop, depending upon what the other mix of credit is.
Got it.
If you can keep that perfect mix of credit, that's the key. And by the way, on this note, I occasionally have people say, well, isn't the American dream to have your house paid off, everything paid off, and all you have is maybe credit cards to use occasionally? And that's okay. If all you have is 3 or 4 credit cards and that's your entire credit portfolio, as long as you keep using them, you keep those balances low, your scores are still going to be in the mid 700s. It's just, if you want that perfect mix, you want the high 700s, 800 FICO score, you're probably going to have that perfect mix of installment and credit cards.
Got it. And that perfect mix, by the way, that you refer to, just for your reference, it can be accessed on that downloadable brochure that's underneath the video stream that you're watching that Jim has provided us. Can you talk for a second about the rationale as to why we're worse off if we have disputes or file those disputes?
As I talk to loan officers, that's the common thing that they're always worried about is when they pull the credit report, they're probably more concerned today looking at, are any of those creditors, is there a dispute on them? And again, because if there is a dispute, first of all, it could take some time to get that dispute removed, depending on the creditor, depending on what it says. And then even once you get the dispute removed, and so it could take weeks or longer, because once there's a credit report that's been pulled and has disputes, the lender cannot submit that through automated underwriting. So they cannot get findings on that file. So basically they cannot do the loan until those disputes are removed.
Got it.
Yeah.
Got it. That's helpful. So here's a specific question that we received, kind of going back to credit cards. This individual had a credit card closed, and the number was changed because it was fraudulently used, but the same company replaced that card. How does that influence credit?
That's a great question, and I apologize I didn't bring that up earlier. If you have a credit card that has been stolen or some fraudulent activity, most of the time credit card companies are going to close that account and then open up a new card for you. You just need to make sure you contact them and say, as you open up my new account, you're going to transfer my payment history over to this new account as well. But you're going to have to probably proactively ask them to do that. And they will, but you have to ask them. Or they'll just close that account that you've had for 10, 15 years, and guess what? All that payment history goes away, and now you've got a brand new open account with no payment history.
So one of the common themes that we're hearing this morning is be proactive. Be aware that there's a lot of different scenarios that can influence your credit.
Right.
And ask the question. Just ask the questions.
Yep. And get things in writing.
And get things in writing, of
Yes.
course. Our folks know that pretty well, but it's good to reiterate. Here's another question. Does a creditor have to inform a borrower that they are turning over a debt to a collection agency before they actually turn that debt over to the agency?
You know, that's a great question, and I'd like to say I know the exact answer, but I'm going to have to come back on that one. I want to say that they will notify you that, you know, they're writing off your loan or charging off your loan and notifying you, and they may say, and this is going to be sent to a collection agency, but I'm not sure if it's a requirement to say that it's been sent to a collection agency.
Got it. Okay.
So I'll have to check on that.
We'll forward that one to you
Okay.
afterwards.
Okay.
And to that individual who asked that question, Jim will be following up with you. Do you mind, because I think that this is relevant, reviewing the steps on how to properly report a short sale?
Okay. So, and I'm sure there's a lot of short sale experts out there that have some other examples, and the one I often hear is, when it comes down to it, the seller must be in contact with the lender and communicating with the lender to say, I know I'm going to have this amount of money that I still owe you at the end of closing, and to negotiate with them. And the goal is to negotiate with them to say, at the end of all of this, you're going to report my account as paid as agreed. And by saying paid as agreed, it doesn't affect your credit. The challenge is just getting the lender to negotiate with you on whatever that term is, whether sometimes they'll forgive the full amount or they will not forgive any of it or maybe a portion of it, and then you have to negotiate with them on maybe doing an unsecured note for that difference. But again, making sure that whatever you agree on, especially if they're going to do an unsecured note for the difference,
Right.
you should ask them to get on this, in writing that you're going to say paid as agreed.
Right.
Yeah.
Make sure you get it in writing.
Get it in writing.
I like it. Another question on credit cards. Is a balance taken in the aggregate among multiple lines of credit cards? Or is that balance considered on an individual line basis?
The balances are looked at on an individual basis. So at one time, there was a perception that we just looked at all the credit cards, we looked at all the credit lines, and we just summed up everything, and that's not the case. They actually look at every credit card individually. A great example of that is you could have 2 credit cards maxed out, 2 with no balances, and these 2 high credit card balances are going to be affecting your score 35, 40 points.
Right.
And often we'll recommend transfer those balances over to the other 2 and make all 4 counts at a 30% high credit. And then that actually would raise your score. But it doesn't just accumulate all 4 together. You've got to move balances around appropriately to get that 30% of the high credit perfect scenario.
So that makes a good segue into the final question. It's almost impossible, I think, for the average consumer to understand, I guess, the magic formula that creates the perfect credit score. And while some of us, I guess, want to achieve that, we just want a good, solid credit score so that we can achieve those goals that we set for ourselves financially. What is the best advice that you can impart upon us that we can remember on a day-to-day basis as we just kind of go about our lives to ensure that we have that credit score that we're aspiring to?
I think obviously we all need to live within our means and not use credit cards to live a certain lifestyle, to keep those credit card balances consistently at 30%. I think that's where we see FICO scores impacted more than anything, besides derogatory stuff, is where you've got 4 or 5 credit cards and they're all maxed out.
Right.
And we've had cases where customers have money available to pay off 5 credit cards and bring them all down to 30% and raise their score 100 points.
Right.
So I think that's a real important one, keeping those credit card balances low.
Right.
Using them often, and then try to have that perfect mix that we've talked about. If you can have 2 other installment loans.
Right.
But even if you don't, again, I've talked to, people that are retirement, they don't want to have a mortgage or a car loan, whatever.
Right.
Then just have those 3, 4 credit cards and keep those balances low.
Got it.
Yeah.
So as you're moving toward those stages in your life, would you recommend doing that more gradually, kind of weaning yourself off those credit avenues, or taking some of those quick fixes down to those 3 cards?
I think back to that perfect mix. It's okay to have 3 credit cards and have 8 additional credit cards that you use once in a while, but you pay them off immediately. So there's nothing wrong with having 10 credit cards. I think the question then comes up is people start to be concerned about identity theft.
Right.
You've got way too many cards to track and keep track of.
Right.
So I think it's a good idea to get it down to 3 or 4.
Right.
So.
Or manageable.
Or manageable.
Exactly. Right. Jim, thank you so
much.
Thank you. We appreciate your time and, again, your expertise. We really appreciate you being here, and thank you for joining us as well. Just as a reminder, we have a full schedule of webcast events throughout the remainder of the spring. I guess it's almost spring. We hope it is anyway. And you can register for those at coloradorealtors.com. A majority of them are free, or you can click the green follow button there along the right-hand side of your screen, and that's an easy way to follow our program as well. So that's it from here. Take care and enjoy the rest of your day.